Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into another episode of the Money Insights Podcast, where we talk all things money and business. My name's Christian Allen, and I'm here with my co-host, Rodney the Pod Zabriskie. Rod, what's up, my friend?
Hey, I am doing great. Glad to be here. It's a good time to be alive.
Yes, it is. And we're going to talk about Rod's 5 misconceptions about alternative investing.
Yep.
And I want to emphasize that these are Rod's misconceptions. So I'm not going to take ownership of any of them. I'm just teasing. No, Rod did a fantastic job putting together our outline today. And we're excited because this concept comes up, or this kind of question of misconceptions around alternative investing pops up in our conversations literally every day.
Yep.
So for that reason, we thought it probably makes sense to get out in front of it and have a good conversation around these things because it's everywhere. Okay, Rod, so before we do anything else, why don't you kick us off by defining what alternative investments actually are so that everyone has a reference point for what we're talking about?
Yeah, absolutely. It's funny because we think of alternative investments as being basically anything outside of the stock market, right? So stocks, bonds,
Yep.
mutual funds, that kind of thing. And I just always can't help but just think of the irony of that. The traditional investing is the stock market, and yet real estate investing, for example, has been around for certainly much longer.
Yeah, it really is interesting. I guess the reason for it, and I'm just kind of speaking what's coming to my mind in the moment, so don't hold me to this, but it seems like it must be the fact that it got commercialized. In other words, a couple of things. The commercialization of the stock market, which has made a massive difference in terms of the ability for companies, people, everyone to make money. And so from that standpoint, it's a really powerful engine. And then the other thing that comes to mind is just the incredible ease of investing in the stock market, right? We talk about being able to really easily do it through a 401k at work or those types of things. And so it's been made so easy, so accessible that it's kind of like it's just become what is considered the norm. And yet, like you said, many of these other types of investing have been around a lot longer. And we're going to talk about some of those things, those misconceptions that have maybe been holding people back from jumping into it.
Yeah. And I would say for people and I agree with everything you just said. And yet there are people out there, maybe their parents invested in real estate or were business owners or whatever. And so it just feels natural for them in the same way that it feels natural for people just to gravitate toward the stock market. Right. So we'll get into more detail on this, but I think familiarity skews our view of investing in some of these other things. Okay. So you wanted to start with kind of talking about what is an alternative investment?
Yes.
Again, anything outside of the stock market. So it could be real estate in a lot of different forms. You could own real estate directly and you're the landlord. You can have invest in kind of crowdfunding, syndications, and other ways of group funding into real estate, etc. Right? Lots of different ways. It could be in a business. And again, lots of ways. It could be your own business. It could be your friend's business and you're just becoming an investor in that. It could be venture capital, right? Where you're participating at that, kind of, again, crowdfunding type of thing. It could be precious metals. It could be notes, right? Hard money lending or a lot of different mortgage notes and other things that you can get into in funds. Cryptocurrency, obviously. We talk a lot about cash value life insurance. That obviously fits in this category. Oil and gas and other commodities. I was talking to a guy last week who was talking about how he lives in Utah, but he invests in cattle in Texas. So he literally owns these, whatever number of longhorn,
whatever
bulls
works,
that are
Rod.
wandering around in the,
there's
in
that's
Texas.
it. There's so many ways to invest, right? And you can be pretty creative with it. So I haven't run into a ton of people that are investing in other people's cattle ranches.
Yeah.
But it doesn't surprise me. You can go and invest in so many different ways. It's kind of crazy.
Yeah. And one last one is collectibles. We talk to people who again, a car collection, right? And you automatically might think, well, people may just own a lot of cars because they like those cars, and that's certainly true. And yet they carry value, and the value can go up over time as they become, vintage and all these kinds of things. And
so Rod, are you suggesting, it sounds like what you're suggesting is that if you want to make a really solid investment, you go out and you buy that brand new Maserati and you drive that thing and enjoy it, and then you just sell it for more. That's easy.
I'm not pretending to know if that's even possible, but there
okay,
are those
but what
who
you do know is that we have run into people who make money investing in cars, right?
Yeah.
So kind of an interesting.
Here's
niche.
another one that's interesting. Watches. I talked to a guy who knows that world and literally invests in watches, because they not only carry value, but they increase in value. Again, I mean, who knew? But
okay, so let's be careful about these. They don't. Some do. If you're probably skilled and know what you're doing, that can happen across really anything, right?
Yep.
I mean, memorabilia. How often do people invest in sports memorabilia? And cards were really popular back in the day, and it seems like they've made somewhat of a comeback. So. Yeah. NFTs, Rod. We didn't talk about NFTs. That's another one kind of in the cryptocurrency type world. So there really are 100 different ways that you could invest inside of the alternative space. Now, we kind of have our core stuff, right? Like real estate's kind of at the core of it, and maybe some niches within that. But I think it's important to know just that there's a lot of availability, and it's kind of interesting. You can kind of pick what you're interested in and almost make investing, connect with what you're interested in. And that's one of the cool kind of unique things about playing in the alternative space.
Yep.
Okay, Rod. So we went through our list. I think it's a pretty thorough list. Really quick: real estate, business, precious metals, notes, cryptocurrency, cash value, life insurance, oil and gas, other commodities, collectibles, cars, watches, art. We talked about NFTs. So we kind of hit a pretty broad spectrum. Sounds okay, good. Rod. So now that we've talked about and defined what the actual what alternative investments consist of, had a pretty good thorough list. Let's talk about what those actual misconceptions are. And I think number one might be the most widely spread. So I'm glad that you put it there. But the first one is that alternative investments are inherently more risky than investing in the stock market. And that seems to be what people think. That's just kind of the general conception.
And I think it really goes back to what you said earlier about just familiarity and the idea that the stock market is ubiquitous. We don't even have to think about it. I mentioned the stock market and people just know what that is. I've never met anybody that didn't. Right.
Yeah, that's absolutely fair. They're literally, I mean, it doesn't matter how old you are, right? My kids know what the stock market is because, they see the tickers and they see. So it's just become so commonplace that by the time you get to a place where you actually have money to invest, it's almost just become, the obvious, simple, straightforward place to do it. And again, a lot of it's just kind of that following the crowd mentality, right? We just don't think outside the box to realize that there's more opportunity out there. And so again, moving into alternative investments is kind of like starting your own business, right? Like you're kind of moving into this world that's not as common. It's not as visible. And so you have to do a little bit more work to find those areas where you can really learn it and dive into it.
Yeah. And so as it relates to risk, the misnomer is that when you invest in the stock market, you're taking on risk. And I think people understand that. Sure. And yet, again, going back to the whole idea of just familiarity, what we think we know about the stock market seems to lead to this perception that there's less risk than something that I don't know as much about. It just must be more risky. If it was the same as investing in the stock market, then I'd know more about it. Right.
Yeah, that's it. And again, it's ease, it's simplicity.
Yeah.
So those things come into play.
Yeah.
Okay. So we talked about just the simplicity of it, and talk a little bit about this concept of risk-adjusted return, because this is one that I've hit on a few times, and I think it's important. Most people, again, just don't understand the concept, and I think shedding light on it is kind of that first step to making sense.
Yeah, and I think it begins with just opening your mind that there may be other things out there that can be valuable that I can invest in, that may or may not carry the same risk as I'm taking on when I invest in the stock market that I may not even know about, right? I'm investing in a mutual fund and someone else is making all the decisions about what gets included in that mutual fund, right? And so, but here, like risk adjusted return. So take real estate as an example, right? I agree. It would be more risky for me to go and invest, like buy my own property right now at this moment, say for example, in Utah, than it would be to go buy, whatever Tesla stock, right?
Oh, that's suspect, Rod. I don't know. It's
you don't know, right? But just what I know about the market right now in Utah is that it wouldn't.
Yeah,
be a
it's
great
hard to
decision
find.
just go
It's
buy a
hard to
piece of
find great
property,
deals,
right?
Yeah.
So, but at the same time, we often talk about Western Wealth Capital as a syndicator that you can invest with, and I have all the confidence in the world because of the process that they use when they are considering a property, acquiring it, putting it in place, upgrading it, all of the different pieces that they have that they use, that as far as the risk associated with it, I feel like there's very little risk in investing with them as an example, right? As an operator that I have confidence in. And so risk adjusted return is just saying, if I can go with them and get a 20 to 30% annualized return, I feel like that's less risky than investing in Tesla, for example, right? Could I get a 20 to 30% return with Tesla? Absolutely, right? They're doing amazing things, and like all the things that Elon Musk takes on, are like grandiose.
And it turns to gold, but
and absolutely could. But is it more risky to do that than it would be to go again in the syndication? For me at this moment, I feel like it would be more risky. And so it's just hard to throw a blanket over everything and say all alternative investments, or even just all real estate, or even all crypto or whatever, right, is more risky than whatever investing in something I'm more familiar with, like Coca-Cola or whatever.
Hey, sorry for the interruption. Just wanted to let you know that you can take the F3 assessment right now over at moneyinsights.net. And after the short 5-minute assessment, you'll get specific recommendations that will help you move from high income to high net worth. Enjoy the rest of the show. And I think historically, it's just important for people to understand that the risk-adjusted return, there is like a calculation to create risk-adjusted return, right?
Mm-hmm.
And real estate historically has had a better profile from that standpoint than, say, the stock market. So, and I always say this, but it's not that I don't think there's a place for the stock market, but today we're going to focus on the misconceptions. So if it sounds like we're beating up on the stock market, we probably are a little bit.
Yeah.
But again, I just want to emphasize that in the right situations, it's not that it's bad. It's just that as a general rule, we like to invest in the alternative space first, and then in situations where we need to, like a defined benefit plan or something like that, might make sense to be in the market. Okay, Rod, number 2 misconception: alternative investments are more complex.
Yes, and this gets, again, I'm going to go back to this whole familiarity idea, that something happens in our brains when we're more familiar with it. We think we understand it, and if we're less familiar with it, then it just has all kinds of warts and holes and things like that.
Well, and it's even just like, I don't even think it's red flags. I think the familiarity doesn't necessarily make us poke a hole in it. It's just the concept of comfort,
mm-hmm.
right? Because it's around us. We talk about it. We think everybody else is doing it. For that reason, it naturally feels comfortable to us.
Yeah.
Now, when we go to something that's a little bit different, that's not as in front of our face,
mm-hmm.
like that feels different. That feels uncomfortable. It's just the way we're built.
Yeah.
And so we have to overcome that. And what's funny is that once people move into that alternative space more often, they feel the opposite way, right?
Yeah.
And so it's just an interesting dynamic, but I really think it has to do with familiarity comes a level of just natural comfort.
Absolutely. And I'll give you a good example. So people who think they know, a lot about the stock market are often shocked to find out that there are more costs, more fees involved in investing than they thought. And so here's a good example, right? So let's say you traditionally invest in mutual funds, and you get to the end of the year and you find out, hey, my mutual fund grew by 10% this year. That feels pretty good, right?
Yep.
Well, what they don't realize and aren't thinking about is that their actual return was really probably something like 7%. Because if you paid your broker a percentage to help you with it, all of the transaction fees, so there are seen costs, there are unseen costs that are real, and so you might end up with like a 3% fee. And what's interesting is you're paying that 3% fee no matter what. So when it goes up 10%, you really only realized 7%. If it went down 10%, you actually lost 13, right? Because you paid the 3% either way.
Yes.
Right?
Okay. So we might be exaggerating it. Okay. I say that. And there are places where we've seen people who are paying 3%.
Especially in a 401k when you add another layer, right? So
sure. Yeah. There's definitely opportunity in, like a variable annuity and things like that are attached to just high fees. And so I think the misconception here is just that they are inherently simpler, but also less expensive.
Mm-hmm.
Sorry, that was a struggle for me to get out. But again, I think the emphasis here is that people assume that when we get into something that's less familiar, that the fees associated with it, because it's unique and different, naturally are going to be more absorbent than what we're dealing with on the market side. And what you're suggesting here is just that we generally, or we talk to people that are savvy and do know, but most people don't even know what they're paying in their brokerage accounts.
Yeah.
Okay. Good point.
Yep. Yeah. And maybe just to kind of nail that home is the kind of the whole point of bringing up the thing with the fees is when someone is getting into something that they're less familiar with, they dig deeper for good reason. And yet when they feel like they're already familiar with it, they don't feel the need to dig. They just feel like, oh, well, it just is what it is. If it went up 10%, then I gained 10%. And we run into so many people who get to this realization that, it wasn't 10% or it wasn't whatever, right? I'm not growing. My money's not growing in as much as it should be based on what they're telling me I'm earning because of all these fees. And so, regardless of where you invest, just right, understand it, dig into it, get into the different layers and understand what you're investing in.
Okay, Rod. So the first misconception is that alternative investments are riskier. Second one is that they're more complex. Third one, Rod, is that it requires more money, requires more capital to get involved with them. Talk about that.
I think the biggest place that this comes from, going back to real estate, is a lot of people are unfamiliar with the different ways that you can invest in real estate. They think that the only way to do it is to go buy your own property. And especially now, recently with this big jump in property values, if it's like, well, even if I'm getting, 75% of the purchase price through a loan from the bank, I still have to come up with 100, 200 grand in order to get a decent place.
Yep.
And so that's admittedly for a lot of people, a big number, a big nut to crack to get started. And so but if I can go buy mutual funds, I can put, $50 toward it, depending on which, fund I'm getting into, but I can do that. So go ahead.
I was just going to say what they've done is they've changed the game more recently on the alternative space. Like over the last few years, it started to become normalized, and there's places where you can invest small chunks at a time, whereas that wasn't historically available. And so like the misconception here again is rooted in some truth. And the truth is that historically alternative investing has required more capital initially to get involved with. And what's really nice is that because of the various ways, like you're saying, Rod, the various ways that exist to invest in real estate and other types of things, you can almost invest in any type of asset nowadays, starting with a relatively low number of dollars.
Yep. Yeah. So we're familiar with funds, like a mortgage fund comes to mind, where you can start with as little as $100, right?
Yep.
And in the real estate, some of these syndications, it might be like a $25,000 minimum for accredited investors or things like that. But again, that's a much lower number than the couple $100,000 that we talked about a minute ago. So again, yes, that's a bigger number than getting to the stock market. I guess my whole point was just to maybe help people see that it just may not be as big as you think it is. Right.
Yeah, and there's likely ways to do it. Like at the end of the day, if you have the desire to get into the alternative space, regardless of how much money you have, there is a way to do it without question.
Yep.
Okay, Rod, number 4 is that it requires more time to invest in the alternative space. Is that true?
Well, I think it is true for most of us. Again, the person who shows up at the office and the HR director says, "Okay, sign here," and now you're in. Like you're starting to invest in the stock market.
So from that standpoint, it might be a little bit more time.
Yeah, they make it easier over there, and yet, if kind of going back to what we talked about a minute ago, if we are going to put in the time to understand what we're investing in, then maybe not, because it's going to take research on either side. If I want to truly understand what I'm investing in and make sure that it's, I'm comfortable with it and that's what I want.
Well, okay, so that's the key. That's really the key. It's about you as an individual investing time into anything that you're investing in, right? So like the familiarity with the stock market doesn't necessarily mean that we know it any better. We just have a familiarity, a comfort with it. And so what you're saying here is just that from a time standpoint, the misconception is that it doesn't have to take more time. Often it can take more time because of the fact that we have to create this familiarity with what those things are and where we go to find them. And so maybe it's less of a misconception that it requires more time initially, but ongoingly it can be as passive as you'd like it to be, right?
Absolutely. Yep, absolutely. And maybe another piece to put on this as far as it relates to time, where again it is rooted in truth, is with a lot of the alternative investments, there may be a lack of liquidity for a period of time. So I mentioned Western Wealth earlier. When I invest with them, I know that it's going to be likely 3 to 5 years before I'll get my original capital back, right? And so that may be true, and yet when I say that, I can't help but think, the kind of Dave Ramsey voice in my head is saying, yes, but investing in the stock market is for the long term, right? So
and maybe more so than that. Okay, finish, Rod.
Yeah, the message there is that don't freak out when market is down or whatever. Just wait it out. We're investing for the long term, and so I get it's a kind of a liquidity thing, and yet that's the mindset for so many people going into investing in the stock market as well.
Okay, and the other issue is that most of the time it's happening inside qualified plans, so the intention there is for it to be long term.
That needs to be, yeah.
From a time standpoint, most financial voices are saying throw as much money into your qualified plans as you possibly can. And of course, the challenge there is that when you want to get them back, when you want to get that money back, you could pay a fee for it, and you're definitely going to pay taxes, right?
Yep.
So yes, I think the kind of core point here, and really with all of them, like you're saying, is that they're not always true. And the misconception is when it's used as a statement of fact and trying to make it a broad statement of fact, because in reality, again, the world that we live in today, you can just do all of the same things. I can just go sign a few pieces of paper and get into a crowdfunding deal. In fact, I don't even have to sign paper. I can just go on and do it online and start putting money into cryptocurrency or NFTs or really anything. And that's kind of the core here. Now, what we're not suggesting is just going, rampantly finding things and throwing money there. But we are suggesting that at its core, the alternative space is just as easy. Once you get your kind of foot in the door, it's just as easy to invest as anywhere else.
Yep.
Okay, Rodney, did we hit number 4 strong enough? You feel good about that?
Yeah, I think so.
Okay, number 5 on Rod's 5 misconceptions about alternative investing, that you have to invest in the stock market first. Okay, Rod, I feel like we're just beating the stock market to death today. So I guess you're just going to keep piling on. So go for it.
It's the culprit. Okay, so the idea on this one is just that so many of the voices out there say, okay, alternative investments may have a place, but you have to invest in the stock market first. You can't just, jump in on some of this other crazy stuff, the weird things like real estate and businesses, whatever.
Yeah, we don't want to get wild and crazy by investing in real estate and business.
Get yourself in, create a firm base first in the stock market. And then if you want to diversify outside and do some other things, then go for it. But that's kind of the message that I see a lot.
Okay. So why is that a misconception, Rod? Why don't you have to do that?
Well, I know that I meet people on a regular basis who don't do that.
Okay.
And they're not hurting in terms of their ability to build wealth.
Okay, so at the end of the day, Rod, number 5 misconception, you have to invest in the stock market first before you can diversify into alternatives, is simply not true.
It's just not necessary.
Okay, so game, set, and match around alternative investment misconceptions are 5: riskier than the stock market, more complex, requires more capital, requires more time, and finally, you have to invest in the stock market first. I think we have debunked all of those things, Rod. Would you say so?
Yeah, and I just want to clarify. So a couple of times you said these are Rod's 5 misconceptions.
They are.
And they were I used to have these misconceptions, and now I've come to the light.
Okay. I see where you're going with that. So those are not, they're not possessive. Like you don't still have those.
Yeah.
Those were yours at one point in time.
Yep. I'm done.
Okay. So if you can go down that path, Rod, then anybody can, right?
Yeah. Yep.
All right. I like it. Okay. So let's talk about kind of what to take from this, Rod. From your standpoint, what are the core takeaways from these 5 misconceptions?
Yeah. So I think number 1 is to know what you're investing in. Even if it's seemingly familiar, you think you understand, and know what's going on. Make sure you're digging deep, do the research, understand. If it's on the stock market side, again, like you said, fine. We're not opposed to people investing in some form in the stock market, but just know what you're investing in and how the fee structure works and those kinds of things. Same thing on the alternative side. If you want to get investing in real estate, understand what you're getting into, and regardless of what route you choose. For example, if you do go the syndication route, then understand the operator and make sure that you're absolutely comfortable with what they're doing, because in that world, it's not as much about the specific property as it is about what they're doing with the property and how they acquired all those different pieces that the operator brings to the table. So I think that's number 1, really know what you're investing in. Number 2 is that you can rely on experts. You don't necessarily have to become the expert in all things. And that's true on both sides. We do that with mortgage brokers, with our kind of 401k professional, that we work with there. Same can be true in investing in real estate. There are people that you can become to trust and understand and know their approach and be comfortable with that. And that helps add a level of comfort when you are investing. And then third, I would just say either way, you need to be the quarterback of your investment portfolio. So even if you are using a stockbroker, still stay involved, understand what they're doing and direct them, right? We meet with a lot of people who thought that all they needed to do is throw their money at this person and then they'll take it from there. And then found out that maybe doing that wasn't the best idea, right? Because they just didn't understand. They didn't know what was happening behind the curtain until later. And it wasn't that the person was, dishonest or whatever, but they just didn't understand and later found out and were unhappy about how those decisions were being made to invest. But if they had stayed more involved, then maybe it wouldn't have been as bad. But again, the same is going to be true on both sides, right? You be the quarterback. You kind of call the shots, make sure the experts that you are relying on know what you want and are acting on your behalf to accomplish those things.
Can I just say, Rod, you're making investing sound like an awful lot of work. Can I just tell you?
There has to be some work.
Okay, so I have some thoughts on this before we close things up here. Here's my thought. It requires some effort on the front end, particularly. Here's the deal. There are several simple, very passive ways to invest, whether it's in the market or whether it's in the alternative space. You can do it. And so we hope that Rod's list doesn't scare you too much, because there is some effort that usually is required on the front end, but you can absolutely be someone that decides to do it passively, right? We have many high income earning, as an example, physicians, surgeons that work 15 hours a day and, and they still manage to prolifically invest in real estate. So it does require some effort, but it doesn't have to require long-term, ongoing, significant effort if you want to be a passive investor. So I just wanted to kind of clarify that in case people were thinking like, gosh, this sounds like a lot. Where do I start?
Yeah, that's a great point.
Okay, Rod, I feel like we need one more piece of advice before we close it up. If you're someone listening to this and you're thinking like, okay, I do want to get into the alternative investment space. Maybe I actually have been feeling one or more of these misconceptions. Where do I start? What do I do next? Like, how do I get involved if that's something I'm interested in?
I think one thing you said earlier really helps with that. And that is people have interests, right? And so, or they have friends, that they may know that are in this space. And so if you can build on things that you already know as a starting point, and so you brought up the Maserati example earlier, and that's not my world. I know nothing about that. But if you're someone who does, then maybe that's an interesting place to start, right? And so you can amplify your efforts by what you already know as a starting point, or like I said, rely on a brother, a friend, parents who have some level of knowledge and help that kind of give you a jump start.
Or perhaps the hosts of the Money Insights podcast
That's possible.
Could give you some direction on where to go. Here's my advice. If you want to get involved in the alternative space and don't know where to start, we are happy to point you in the right directions. Talk to us. We'll make sure that we do it. Okay, Rodney, I love your list. Those were Rod's previous 5 misconceptions around alternative investments. And we will see you all next week on the Money Insights podcast.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.